Hi, Jeff Higley with HotelNewsNow.com. I'm here with Mitt Shah from Noble Investment Group. Mitt, thanks for taking the time to chat.
Thanks, Jeff. It's always a pleasure.
Talk about your portfolio a little bit. How is it split between the full service and select service? What's your portfolio look like today?
We own 45 hotels. Of those 45, 17 are full service. The balance are premium select service and extended stay. And our focus, as you well know, has always been to take an existing brand or a hotel that is in need of significant physical enhancement and operational enhancement, and then fix those things. So we're taking brand X and we're converting it to brand Y, and we're also re-engineering food and beverage space, meeting space, and the like. But we've always had a real bias for transient demand hotels. And the reason why is that while it's day to day, you can predict the stability of it. And even in times whereby businesses cut travel budgets and consumers were afraid to travel because they were worried about their own jobs, and that's a great predictor of leisure demand. How afraid are you of whether or not you have a job long term? Even then, you see 07 to 08 to 09 to 10 and 11 and now 12 transient demand on a clip year over year, very strong. So there's always been a bias. The question is, where can you actually add value? So over the last 12 months, we bought 15 hotels, and all 15 have been transient demand oriented hotels. And I believe that as you see our portfolio going forward, it will have a very, very high bias towards premium select service, extended stay, and compact full service, which generates most of the demand from the transient traveler.
And a compact full service, that's an interesting term. Explain exactly what that means.
That's a full service hotel that is somewhere around 200 to 250 rooms, probably at the top end, whose primary revenue generation model is not built off of having 20,000 group room nights a year. It's a hotel where at least 2/3 of his business comes from the transient business travel as opposed to group. So while we believe that group will always be a big part of our industry, our real concern is that until there's really robust labor growth, that the group demand is not going to be able to pick up in volume, and the spend is not going to be what it historically was.
Your company has built its portfolio through a variety of creative financing, including some funds that you've partnered with people with. Talk about where you go from here in terms of financing the next 15 that you want to buy.
So we've been very fortunate that we're entrusted as a fiduciary in a private equity real estate fund business model. And so like RLJ was before they were public, and HEI and others, we enjoy the ability to have discretionary capital in a fund basis that allows us to be very, very proactive in terms of sourcing opportunities, very decisive in executing opportunities, but it requires us being a great fiduciary. That said, our model is one which allows for continuous ability to invest capital and deploy capital as long as we continue to do what we've been doing. So we just finished investing, which is committing, Noble Hospitality Fund, which is our third private equity platform. We had our first closing on Noble Hospitality, on our next Noble Hospitality Fund. Our thesis has always been to invest $100 million of equity a year. So leverage, that's between $200 and $250 million of assets a year. Last year we did $350 million in assets, but a lot of that was things that we had been incubating over time. And so I believe that we'll continue to find one-off opportunities, $20 to $30 million individual investments on an ongoing basis. We're now in a scenario whereby $175 billion of lodging loan maturities are going to take place at the same time where brands are going to continue to mandate property improvement plans. And a lot of the owner-operators in our business, many of which are here today and at brand conferences throughout the country, are going to face challenges that they've never faced before in terms of a lender saying we need a 11% debt yield on the asset to refinance. And we think the world of you, but the FDIC is mandating we do this. At the same time where the brand is saying, we know that we haven't forced you to do X, Y, and Z over the last 3 years, but it's more than carpet, wall covering, and televisions. It's technology systems and the like that needs to be in place. So I've been believing, the organization's been believing that this was going to take place for some time.
So when you acquire a new hotel and it's facing, in some cases, deferred maintenance of maybe 10 years, How does Noble then fund that? Is it all part of the acquisition fund?
It's all part of the capitalization. And I'm not sure, you have some hotels that have had some longer term deferred maintenance. We're probably really talking about 5, 6, 7 years of deferred maintenance. And the brands have been actually fantastic partners for the industry over the last several years, in that they understood what was happening. And they took the foot off the pedal in terms of mandating some of these very substantial upgrades. So it is important to recognize that this is more than case goods. Right? Does a dresser need to be replaced or not? Yes or no, right? Just because it's 7 years doesn't mean a dresser has to be replaced. But the technology side of our business is something that is going to require some significant investment from everybody because of the transparency and because of how business is done today.
Where do you see yourself growing as far as properties in the next 5 years? You have 45 now. Do you have a magic number for where you want to be?
We're at it's likely that we'll invest the current fund that we'll have over the next 2 years before we start monetizing the broader portfolio. What's likely to happen is we'll be sellers over the next couple of years on certain assets. And then we'll be looking to put together a very nice, homogeneous portfolio of transient, demand-oriented hotels that have a very attractive yield associated to them, that will look and feel like great portfolios that have existed in our industry over time. Our bread and butter business is, again, take brand X and convert it to brand Y. But we've also developed 30 hotels in our history, and currently we're under development, brand new construction on 2. There's only a couple things that are important for us. One is that we're inherently lower leverage than what the market is, right? So even in the heyday, we were no more than 65%. So today it's probably closer to 60%. That's one. 2 is we want to achieve a double-digit unleveraged yield in the first 36 months of our investment. And lastly, we're very focused on 2x equity multiples in terms of our overall exit.
So in the public-private partnerships that you've had over the years, is that something that is going to continue to be a part of the industry? Has it gone away? How's that whole shaping up?
How many municipalities really need a hotel, and what are they willing to pay for? One of the interesting questions is that as cities struggle with their own tax base and where dollars go, to ultimately end up subsidizing private enterprise is politically not something that a lot of municipalities want to go and do. But there's lots of ways in which to do it. There's property tax abatements, there's hotel motel tax opportunities. So from a structuring standpoint, our team is really good. If there's a need in a specific market area and demand that's there that we can justify, there's a lot of different creative ways in which to accomplish, call it public-private type of opportunities.
Mitt, what's the biggest challenge for Noble for 2012, 2013, and how do you address that? How do you move forward with that?
Well, I like our organizational structure. We have simplified our business, and we're focused on a niche of the business that I believe is very, very attractive and is very financially oriented to historically the right ways in which to make money in our business. And in times past, I'll be the first to admit that we were all across the board. We were looking at public-private opportunities, we were looking at some resort opportunities, full-service opportunities, and select. We've really synthesized that to a very simplified approach that I'm very, very eager for us to continue to take advantage of. With simplicity and with focus comes quality of life.